We have had quite the week, quite the month, quite the 2 months. And I don't think it's going to be slowing down anytime soon. You may want to check out in the details and go back and look at Brighter with Herbert earlier today. He describes his own video this way. He says Tesla stock is soaring, and investors are wondering, is this the top or just the beginning? Today, they met with Dr. Jim Thorne. He's the chief market strategist at Wellington Altus Private Wealth. And it's a large company. I guess they have about 30 billion or so under management. And he's targeting $700 for Tesla in 2025. What an idea. He says he has a significant bullish position in Tesla, and he expects it to top out at 1,000 in this cycle. He never quite describes what he means by this cycle. I suppose he means it might get to 1,000 and then back off to 500 or 700 or something like that after it gets to 1,000. He never really quite let us know what that meant to him. He says Tesla just wants to go up, and so it's kind of in that position, both based on the macro, based on the charts, based on the fundamentals. For all three reasons, it wants to go up. It just needs good news, and as the good news comes in, it just continues to pop. He does see risk on for the entire Trump administration and thinks that the S&P will be at 14,000 by the end of the Trump years. So pretty bullish on the Trump situation as well. Okay, so now when we hit this kind of exuberance and we get top experts all lining up in agreement about where we're going, and that also happens to coincide with Brian Wang and me, where what we were saying months ago, I think that that's the time when you really want to take a step back a little bit and make sure that what I said 3 months ago, what Brian's been saying in the last 24 hours, if you've been watching, and we've got one more Brian Wang coming up tonight, although it's not really about pricing. If you've been listening to that and you've seen that we've been really right on, I still want to step back and I want to take another look. So let's go through it again. I've been listening to so many podcasts, read so many articles in the last couple of days. And of course, I've had all the regular guests on this week, plus Robert Scoble. Brian, I'm just in anticipation of doing the show. Brian said we would get to 450 after earnings. Well, we're 14 points away from that now. I said 410 after earnings. We've already blown through that. Brian said 1,000 by the end of the year. I said 700 plus plus. One plus if Robotaxi has a serious rollout, and another plus if Optimus was revealed. Well, now everybody's come to that position. They've all come to the same conclusion as we did months ago. The underlying car and insurance company, energy company, that part of the business is worth all of that 700 by then. Assuming that we have the 100% ramp of Shanghai's megafactory and a 25% increase in vehicle sales, both of which should happen, then we get to 700 anyway. Even if there was no Robotaxi, there was no Optimus at all, just based on those numbers and the continued progress in both of those into future years at roughly 50% a year growth in profits, then you could get to the 700 easily. Now, in my analysis that I did on September 2nd, I did include a little bit for Robotaxi and just another pittance for the payroll savings that Tesla will get by employing 1,000 plus robots. Nobody else is putting that in their numbers. Not a single soul is putting that in their numbers. So after looking back through it again and really thinking about it clearly, I don't have anything that changes my position. I still think 700 plus plus. I think Brian's 1,000 is the plus plus. He's assuming that we will get enough news on Robotaxi and Optimus to get us to 1,000. Now remember, at 1,000, Tesla becomes one of the three largest companies in the world. Microsoft and Apple, but maybe Nvidia will be in there, so maybe 4. I mean, it's number 8 right now and closing in on number 7. But if it gets to 1,000, it's one of the top 3, 4 in the world. So if robotaxi is seriously rolling out and we have some good numbers to review, we can actually analyze how the business plan is working out. It could easily add 100 or more to that 700 prediction that I'm making. And then if Optimus is revealed, now listen to this carefully. If Optimus is revealed to do at least many dozens of useful factory tasks at human speed, and we get the pricing, is it 60,000 a year? Is it 90,000 a year? Is it one-time purchase for 200,000? How does the pricing work? I don't care about the cost. The cost is going to come down radically as they ramp. Then I really don't know what will happen to the price. I mean, seriously, honestly, the TAM is so large, the opportunity is so huge that if we get to see that, if we see these Optimi working and really doing these useful tasks, and it makes sense, and it's not, controlled by, some kind of a remote control deal, it's 100% autonomous, and we get to see it, and it's believable. I really don't know what happens to the price. It could be 1,300. I mean, there really is it's very hard to contemplate what the street will do with that. We've never seen anything like this in history. So how do you really get your arms around how to value it? Realizing, of course, that robotaxi, you've got Kathy Wood. They do very, very good work. She's saying 2,700 on robotaxi in 2029. If you just do a current valuation on that 2,700, if you believe it, you just back that up to today, you'd be way over $1,000 right now. Anyway, there's also the unknown of how quickly Tesla can increase production this year, 2025, I mean, to take advantage of the increase in demand that FSD being unsupervised is going to create. This could add 300,000 vehicles in 2025 that nobody's counting on, and nobody else is talking about that either. Just me. I haven't found anybody else talking about how, if I ask them, they say, well, yeah, duh, but nobody else has got it in their numbers. So if you add another 300,000 vehicles next year, that's, over 10% more just for the vehicle side of it. Plus, of course, as everybody talks about, the FSD uptake increases dramatically. That's one of the things that one of the reasons why Brian is also closer to 1,000 at the end of the year is because of that uptake on FSD. And I will admit, I haven't put as much money in that as he has. So then there's the macro. You can say that the company's worth 700 or 1,000, but if we're risk off, or if the country is not doing well, or the stock market decides to take a breather, well, that's going to impact Tesla as well. So let's talk about that in just a minute. This is Randy Kirk. Please hit the like, subscribe, and notify button tomorrow. Well, tonight, actually, you still got Brian Wang coming on. Tomorrow morning, you've got Warren Redlich with part 2. If you haven't watched part 1 this morning, I'll put up a card for that in a minute. But part 2 of his and my discussion, which was pretty amazing. And then, of course, on Sunday night, you've got the regular Monday morning program where we talk about the Fed meeting next week, as well as other things that will be coming along in the week before Christmas week. So it'll be an interesting week for sure. All right. You could also hit Patreon. It's getting very close to Christmas. As I just mentioned, a lovely Christmas present for your buddy Randy Kirk would be to do something on Patreon. That would be really, seriously, that'd be good. That'd be very nice. Market Watch says, great story, great article here. Now listen to this. The big economic story of 2024, at least as far as the market was concerned, was that the recession never happened. Randy said it would, and I'm still not sure it didn't. That'll come up here in a minute. We'll talk about that in a second. But the recession never happened. As far as the stock market is concerned, the recession never happened. All right. The U.S. economy for the third straight year is going to grow at least 2.5%, maybe more like 2.7 when all is said and done, maybe. Cities, this is from Citibank, by the way, their economic team, led by Andrew Hollenhorst, admits that their forecast for an outright contraction of the U.S. economy was entirely wrong. Quote, our major mistake was to underestimate the extent to which rising net worth of higher income individuals and easy financial conditions for large corporations will continue to drive activity, they said. I'm sorry, I must be starting to sound like I'm bragging. Yes, I also said that the economy would probably get to flat or possibly down just a little bit this year. I was wrong about that. Maybe. I'm not giving up 100%. But what I've been saying all along is the thing that was holding the economy together is just what they just said. This set of corporations over here, the ones that are in tech, and you've heard me say this if you've been listening to the channel, the ones that are in tech, the ones that are in healthcare, the ones that are in leisure and travel, these companies did great. They did great. And government did great. They just hired and spent money like crazy. And that part kept the economy alive, while this whole other sector of small businesses and transportation and manufacturing and anybody in durable goods and go down the list, even automotive, housing, all of those continued to be in depression for the third straight year. Some of them for longer, like housing. So it says they didn't take that into consideration. Oh, also the two markets, the two American economies. One is people making over 100,000 who own property or stocks. They're doing great, fantastic. They're all excited. The people making less than 100,000 that don't own a home, don't own stocks, they're not so thrilled. They're the ones that voted for Trump. They're the ones that said, "What's going on here? How come we're not coming along for the ride?" Well, but they did get other calls right, accurately forecasting stubbornly high inflation and 100 basis points of Fed easing, assuming that we get the last quarter next week, leading the team to give itself a B grade overall. Okay. Now they're laying out their views for 2025, and the view is not pretty. They expect companies to shift from reducing hiring to outright layoffs. I do not agree. I completely disagree. They're going to be so wrong. Those same corporations have lots of money. Those same corporations, the ones that are doing well. But what we're going to see starting to happen in 2025 is the optimism that we've been talking about for 2 weeks now is going to buoy up the manufacturers and the small businesses and all these other groups. And maybe we'll even get housing going again as the Trump administration gets into power. So I do not see the layoffs. Does that mean that we couldn't see the overall employment picture still get a little softer than it is right now? Yeah, maybe. And that's probably why the Fed is going to go ahead with this cut. They believe that it's going to be soft enough that the Fed will continue to make these kind of cuts. They expect the loosening labor market to reduce inflation pressure in the service sector, while softer global conditions will restrain goods prices. And so they say that will lead to aggressive action from the Fed, forecasting quarter-point interest rate cuts at every meeting until July to bring the funds Fed rate between 3% and 3.25%. Far lower than the market expectation, which is for the Fed's fund rate to be about 4% by then. Then how do they explain why the bond market is still sitting at 4.4% on the 10-year? How do they explain the reinversion now that the short-term bonds are now lower than the long-term bonds, and the long-term bonds are up? Why? They don't think inflation is beat at all. And I think they believe that the first year of the Trump administration is going to be strong. And I think that's going to be true. Now, I think we might have been way softer than people think starting in June. You've heard me say this 100 times. I think we might be a little softer than people think right now, maybe even at zero. And again, I'll show you some information in a minute that might help you understand why I keep thinking this way. It says here that if long-term rates fall, that would help the hard-hit housing and manufacturing sectors, but not by much, according to these economists. If the labor market, quote, if the labor market evolves as we expect with the upcoming sharper rise in the unemployment rate, weaker consumer health would weigh against any demand boost from lower rates, they say. There's not going to be any lower demand. Because why? Because those people over 100,000 still have lots of money, and they were making more and more money every day in the stock market as the thing goes crazy. All these Teslaonaires, like you probably are listening right now. The arrival of the new administration isn't changing their outlook very much, positively or negatively. Nobody agrees with that. They say a slowdown in immigration will result in less supply of new workers, but that will be offset by declining labor demand. Well, then why wasn't that part of their earlier analysis? If lower immigration takes out some of the supply, then even if there's a little less demand, then wouldn't that mean those who are still here are going to be doing good? A 10% across the board tariff. Now, this is one thing I do agree with, and I've talked to you about this and talked to you about this till I'm blue in the face. A 10% across the board tariff would only boost inflation by a few tenths of a percentage point and won't have a big impact on growth. So at least they agree with me on that. Cutting corporate tax rates to 15% might be offset by the tariffs, which would be no net fiscal stimulus. I think cutting corporate tax rates to 15% might have a bigger impact than they're talking about. It did last time. Anyway, they're not expecting any miracles on the deficit either. They expect it to be 6.2% of GDP, pretty close to this year's 6.4, and well above the 3.6% average in the 21 years before the pandemic. I think that they're probably right because the DOGE commission is not will not be able, they're not going to have an impact in the first 2 quarters. The earliest you're going to be able to see an impact is going to be the third quarter. Maybe some in the second quarter because there may be some things they can just absolutely flat stop. January 20th, the day Trump comes in there and starts writing off those executive orders, they may be able to stop some spending like immediately. So by the second quarter, there might be some impact. I think they're going to be surprised what the impact is going to be by the end of the year, though. Okay, this is from Bloomberg. This is a different story. This is on, I think this is mind-boggling. It just blows my mind. The Federal Reserve Bank of Philadelphia estimates that U.S. state employment in the second quarter was significantly weaker than official figures from the Bureau of Labor Statistics show. The early estimates indicate lower employment figures in 25 states, higher changes in 2, and small changes in all the others. The Fed Bank takes state payrolls. They take the state payroll figures from the Bureau of Labor Statistics, and they adjust them using the more comprehensive yet less timely quarterly census of employment and wages data. The goal is to help produce a more up-to-date estimate of the government's state benchmark revisions. Not very useful 6 months later. In its preliminary estimate issued in August, the BLS announced that U.S. payrolls in the year through March will probably be revised down by 818,000. We already have reported on that in depth back when they reported it. Around 68,000 per month. The final numbers will be released in the January 2025 employment report on February 7th. But the Philadelphia Fed early benchmark estimate shows that the weaker employment trend likely extended into the second quarter. They found that the payroll jobs in the 50 states and the District of Columbia were down 0.1% compared to the BLS count that showed a 1.1% gain. So we had a negative employment numbers in the second quarter. By state, the regional Fed Bank estimates that the largest revision of employment for the 9-month period ending in June will come from California, where it sees a downward revision of 172,000 jobs. Payrolls in Texas may be revised down by 112,000. An extended forecast by the BLS to the third quarter shows further declines there as well. So I think that what we're going to see here, it's going to be a lot closer to my number than anybody thinks. I don't know. What do I know? I'm just Randy. I've just been studying this for a long, long time, and I don't have a dog in the hunt. I don't have anything to prove. All I do is try my best to analyze all this stuff and see what I think is happening. And I do think that it was worse starting in June than anybody's talking about. Will it actually get down to flatline on GDP? Will it go under, in terms of GDP? We'll know in 6 months what the real numbers are. But until then, I'll just continue to say, I'm okay with being wrong. I always prefer to be wrong on the upside. In other words, my negativity, how often am I negative anyway, is being shown to be incorrect and that it was better than expected. So now what do I think? I think that risk on will continue, even given everything I just said about labor. I think that the report from that first report, Citibank report, was very, very good for the most part. I do think that, so I think risk on will continue. I think Tesla will pass that 1,000 and probably even become the largest company on earth sometime in 2026. But then I've been saying that for a very, 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 very long time, is that 2026 is the year. That's when everything comes together. Later tonight, Brian Wang, part two, will talk about how you might be able to set up an agent to help you pick your stocks and also do your timing. You'll be able to do that on an AI on your Apple or other device next year, he thinks. You have to watch that one. And then this morning, Warren Redlich and I did part one of a two-parter. I just mentioned that. There is the card that I promised you I would put up. And that conversation will continue tomorrow morning. You might want to go back and see part one so that, well, you can watch them. You'll get a lot out of part two, even if you don't see part one. But anyway, I think you'll enjoy the time. And yeah, I think that's all I've got for you right now. Let me know in the comments below what you agreed with, what you disagreed with, and how you see it that might be differently than I do. And for now, though, I'm off to my family Christmas party. So it's been great talking to you.